Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 27th, 2025. How are you doing? I hope you had a really nice Christmas, nice holidays. I hope you had a good trading week last week. I hope you're going to have a good trading week the following week, and thank you very much for coming to my weekend review podcast. I hope you are going to find it beneficial and helpful today. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back and take a look at all the trades that I made last week, my open positions, my closed positions, new positions, old positions. We're going to talk about when I entered the trade, why I entered the trade, what the signal was, or what the signals were, because looking for a confluence of signals always improves your chances to increase your chance for a profitable trade. So when I entered the trade, why I entered the trade, and how I am going to manage the trade going forward, whether it goes my direction, goes against me, right? We need to have rules. We need to have rules at all times in a process that tells us what to do. If then statements. If it does this, I'm going to do that. If this market does that, then I'm going to do this. I've been trading for over 30 years, and every day that goes on that I continue to trade, the more I am certain that you have to have these rules in place. And so anyway, I'm going to show you how I trade. I'm going to show you what I'm looking for the confluences. I'm going to talk about how I position size correctly based upon my account size and the volatility of the market that I'm trading. We're going to talk about where I place my emergency stops, where I place my end of day stops, how I take partial profits if the market moves my way a certain direction on a certain day, and then ultimately how I am going to exit the trade, either to the upside or to the downside. So this is the combination of what I have learned and how I have traded over the last 30 years. And thankfully, I'm very thankful that the methodologies that I use work a lot more than they don't. So that's what I'm going to share with you today. So if you find anything that's helpful today, I really would appreciate it if you could subscribe or hit the like button. Helps YouTube know that there's some valuable content here, and I would certainly appreciate it. So after we take a look at my current positions and what those are doing, we're going to talk a little bit about trader psychology. It is the most important skill in trading. The number one is the ability to create a process, but then more importantly, you have to be able to follow the process with laser beam focus, perfect execution. And if you do this, not every trade is going to be a winner, but if you have good trading principles to start with and then follow them, that's the way to be a long-term profitable trader. And it all comes down to trader psychology as far as doing what you're supposed to do. And so it's always helpful for me to teach trader psychology. And so I hope it's going to be helpful for you as well. After that, I have gone down through my master watch list. I do it every Friday night. And I go down and I look for potential trades for next week. I'm looking for confluences of signals of levels. Now, these particular trades are not at those levels yet, but they're getting kind of close, right? They're in the ballpark. They could happen next week. And so I'm going to go through, show you what I'm looking for as far as the potential trades for next week, and I'll explain what the confluences are and why I'm looking for those if they get to those certain levels and react at those certain levels. So I hope that's going to be helpful for you as well. So to get started, I have to run this U.S. legal disclaimer. So let's get this out of the way quickly. We'll come back and we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, so let's go through my current open positions. We'll start with Shopify. This is Shopify. I entered Shopify here on the 18th of November at $100 or 140 and 47 cents, 140.47. So the question is, look, it's been a great trade, obviously, but the question is, why did I enter here? And this particular trade, now I trade 7 different type of strategies. And so I'll go through and explain on each trade what the strategy was. And it's interesting. It depending on the time of the year and what the market's doing, sometimes I trade a lot of deep dip buys. Sometimes I trade a lot of order blocks. Sometimes I trade higher low V1s, V2s. But in this current market at the moment, trading a lot of what I call an order, or what is called an order block, or what I like to call a smart money area. So, okay. So I enter here on the 18th of November at $140.47. Okay, why? Well, I want you to take a look at this green block here. This is called an order block, or a smart money area. So let me take you back into the past when this order block formed so you can get an idea of what an order block is. So there are multiple, different traders look at order blocks a different way. The way that I look at them, I think, is very simple, and it works very well for me. Some people talk about order blocks like they're very kind of complicated ways, and I don't like to do that. I don't like to do that for my teaching, and I don't like to do that for my trading. So the way that I look at order blocks is how I'm going to explain it to you. Other people may look at it differently, but for me, this works very well. So this order block started back here on the 2nd of September. So why is this an order block? So in order for an order block to form, we first need what is called a swing low in the past. Well, here's a swing low. A swing low has a higher low to the left, and it has a higher low to the right. Well, this has a higher low to the left, this has a higher low to the right. So that is a swing low. Now, after we have a swing low, we need it to be followed by a swing high. A swing high is just the opposite. Here's a swing high. We have a lower high to the left and a lower high to the right. Make sense? So we have a swing low, and then we have a swing high. Now, after you have a swing low and you have a swing high, you need to have another swing low that is lower than the first swing low. Now remember, swing low, you have a lower high to the left, a lower high to the right. We have that. But this swing low is lower than this swing low. So we need a swing low, then we need a swing high, then we need a lower swing low. And once that is in place, then we key off of that first swing high, which is here. And in the future, if you have a swing low, swing high, lower swing low, and then in the future you go above that first swing high like we did, you can see this bar went above this swing high. This is what is called a market structure change, okay? And it's important that you have the swing low, the swing high, the lower swing low. That's the important part, because you're washing out this. This is a liquidity level that's being washed out here, rejected, and then having the ability to go above that swing high. This changes the structure of the chart from a bearish market structure to a bullish market structure, okay? Now, the way that I use order blocks in this area is that once you've changed market structure to the upside and you know that now you have a defined uptrend, I'm looking to buy dips in that uptrend. I don't buy the breakouts. Some people do, and that's fine. This would be a breakout, swing low, swing high, lower swing low, breakout, they buy that. And you can see, had you bought that breakout, it certainly would have worked out well. But the way that I look at these is once I change market structure to the upside, I'm looking to buy dips back in this smart money area, or this order block area. So let's go into the future here and just kind of put a fine point on this. If we look up here where Shopify really took off and rocketed up to the upside, I know where the order block is, right? Because the order block is your lowest closing bar before the market structure changed. You have a swing low, you have a swing high, you have a lower swing low, you have a market structure change. On this day, I know where the order block is because once it's changed structure, it's the lowest closing bar before market structure change. Okay, so that's the high and the low of this order block I bring into the future, and I want to look to buy dips back to this area. But let me take you back to here. So here, when this stock is way up here, in hindsight, with 2020, can I look back here and say that smart money was buying this area? Of course it was, obviously, right? Of course it was. In hindsight, unfortunately, we can't use hindsight going forward, but it gives us an idea, right? So when the stock is way up here and we look back here to the order block, can I confidently say smart money was buying here? Yes, 100% I can say that. So the idea is, if this was smart money once, I bring this smart money area into the future. Now, if it comes back to the smart money, will it still be smart money? It may not. Things can change. But more times than not, if you have smart money in the past, it will be smart money in the future. Not all the time, maybe 65% of the time, maybe 70% of the time, but that's the edge that you're looking for. So look right here. We have a swing low, swing high, lower swing low. We break market structure to the upside. It pulls back. Where does it pull back to? It pulls back exactly to the smart money area before it takes off again. Okay. So when it's way up here, I don't mess with things up here, but I know where the order block is. And so if and when in the future it comes back to the order block, that's where I'm going to be interested in buying. And so this is exactly why I bought it here. So that's why you have the order block. Swing low, swing high, lower swing low, market structure change, and then I'm just waiting for it to come back to the smart money area. So let's change the chart here a little bit. So anyway, so now you know why I have this green block brought into the future. And I entered here on the 18th of November at 140.47. Why? Because it rejected the high of the order block. In other words, it went into the order block, but then closed above the high of the green block, right? So there are multiple ways that I can enter using an order block. I can use a rejection of the high of the order block, like this particular trade. I can use a rejection of the low of the order block. So in this case, maybe it went below the order block during the day, but then close back up in it at the end of the day. That would be a rejection of the bottom. This one that I entered here was a rejection of the top. This one, if it rejected the bottom, it could be a rejection of the bottom. So rejection of the top of the order block, a rejection of the bottom of the order block, or a rejection of some type of moving average or other support zone inside the order block. Okay, this one was just a rejection of the high of the order block. So let's start with this one and we'll play out the trade. So now you can see why I entered rejection of the high of the order block at 140.47. Now, as soon as I see this trade and I decide I'm going to take this trade, the first thing I have to decide is how many shares am I going to buy? Well, the formula that I use is very simple. It's based upon how much do you have in your trading account and what is the volatility of the market at the time you're going to enter the trade, or the time I'm going to enter the trade. So first of all, let's just start with the account size. So it's very simple. I take 1% of however much my trading account is, and let's just say for today's example, I have a $200,000 trading account. Okay, I just take 1% of it. It's that simple. 1% of 200,000, 2,000. If I have a $100,000 trading account, 1% is 1,000. If I have $1 million trading account, 1% is 10,000. So $200,000 trading account times 1% is $2,000. Okay, so now I have this number, $2,000, and now I look over to what is called the average range times 2, or the 2 ATR. Right now, this is $12.64. This is just measuring volatility. An average true range, it means what is the average true range of a particular market on any one day. Well, I take that and times it by 2, and that is going to be my emergency stop. So it's very simple. $200,000 trading account, 1% of that is $2,000 divided by the value of the 2 ATR. The 2 ATR at this moment is 1264. Now, if volatility is higher, this number is going to be higher. And if this number is going to be higher and you divide it into your maximum allowed loss, it's going to be lower. So the takeaway of this is the reason that I use that 2 ATR is that if volatility is higher, I'm going to buy fewer shares. If volatility is lower, I'm going to buy more shares. And it's important that you position size based around volatility. If volatility is nothing and you're used to trading 100 shares, great. If volatility goes up 3 times, then that 100 shares is like trading 300 shares, okay? So again, 1% of my trading account, 1% of 200,000 is $2,000 divided by the value of the 2 ATR is 1264. It tells me to buy 158 shares. For me, this is the proper amount of shares based upon the current market volatility and the account size that I have. So we have a rejection of the high of the order block. I enter 140.47. The very first thing that I do is I look back to my 2 ATR value and I minus that from my entry price. My entry price is 140.47. I minus that from my entry price and I place my emergency stop. Okay, my emergency stop is exactly the value of the 2 ATR below my entry price. So why is that important? Well, if I have 158 shares and it goes down $12.64, how much have I lost? I will lose $2,000, right? That is 1% of my account. 1%, if losing 1% of my account is not fun, but if it happens, okay, fine. I can get past it. I can recover from that. And that's the key. So I have my entry. I do my position sizing. I place my emergency stop, the value of the 2 ATRs below. If it comes down there, that's what I've designed as my maximum allowed loss would be 1% of my account. So it would be $2,000. So that's where I place my emergency stop, 2 ATRs below my entry price. Now, the good news is that this emergency stop, this 1% of my account, in my experience, only happens about 5% of the time. The other 95% of the time, I'm going to lose less than 1% because my end of bar stop, not my emergency stop, but my end of bar stop is going to be much closer to my entry point than my emergency stop. And that's key in trading, is entering a trade where your end of bar stop is actually very close to your entry price. So if you're wrong, you can be wrong small. Now you have the emergency stop down here as your kind of safety net in case something really goes wrong. But like I said, it does happen, but only about 5% of the time. The other 95% of the time is because your end of bar stop gets hit. Where is my end of bar stop on this trade? My end of bar stop on this particular trade would be if we have a close below the low of the order block. And you can see this is much closer than what my emergency stop is. Okay, so now, we've talked about the entry of why I entered the trade, rejection of the high of the order block. We've talked about how I position size based upon the account size and the current market volatility. We've talked about placing the emergency stop 2 ATRs below the entry. And we've also talked about my end of bar stop, which would be a close below the low of the order block. Close is the key point here. So now once I have all these in place, the next thing I do is I take my entry price and I look at the value of the 1.5 ATR. Currently, the value of the 1.5 ATR is $9.48. And so I look at this and I take my entry price plus $9.48. So why do I do this? Well, this is called my 1.5 ATR trailing stop level because it's 1.5 ATRs above my entry. So in trading, once you enter a trade and it starts moving your direction, once it gets to a certain point, you want to start to tighten up your stops. You don't want to give back all of your profits. And so that's why I place my 1.5 ATR trailing stop level above my entry. And when it if and when it gets there, it doesn't mean I do anything. It just means now that I'm in trailing stop mode, which ultimately means if I get to trailing stop mode in the future, if I have a close below a previous bar's low, I'm going to exit half of my position. And by exiting half of your position, it has the effect of basically moving everything up by half. So it's correct trading. If your position moves a certain direction, going into trailing stop mode, which means if you have a close below previous bar's low, you're going to get up half. That just has the effect of cutting everything in half and tightening up. It basically just is tightening up all your stops by half, which is the correct thing to do. Okay, so, and this is the orange line here, the 1.5 ATR trailing stop level. So everything I've talked about so far, as far as where your emergency stop is, where your end of bar stop is, going into trailing stop mode, these are all considered defensive moves. So in other words, if the market goes against me, I need to take action, right? If it hits my emergency stop, I need to take action. If it closes below my end of bar stop, I need to take action. If I get to my trailing stop level and then I have a close below previous bar's low, I need to get out of half. These are all defensive actions, but I also like to play offense in my trading, not just defense, right? Like any good sports team, you need to play both offense and defense. And the way that I play offense is that I take partial profits each day if it moves a certain amount from the previous bar's close. So I'm in this particular trade at the moment. Let me show you exactly how I'm going to do this. It's very simple. What is the closing price of the day? Okay, on Friday it closed at 170.83. So I'll just put in 170.83. Now I look to the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is $2.84. So I take the closing price on Friday, 170.83 plus 284. My first profit target for Monday is $173.63. If it gets there, how much do I take? 10% of however many shares I go into the day with. If I go into the day with 100 shares and it hits my first profit target, 10%, I take off 10 shares. So I'm not taking a lot off, but I'm taking something off, right? So 173 is my first profit target. 170.83 plus 0.45 ATR, which is 284. Add those together, 173.67 is my first profit target for Monday. Now, I always place 3 profit targets each day. So how do I get my second profit target? I just take my first profit target, 173.67, and again, I just add the value of the 0.45 to it, which is 284 plus 284. My second profit target for Monday is 176.51. And I do it one more time. 176.51 plus 284. My third profit target for Monday, 179.35. So I have the potential to take off 10%, 10%, and 10% each day, right? Now, it's kind of hard to hit 3 profit targets. It certainly happens, but if you have a decent day, maybe you hit 1, you take 1 off. If you have kind of a really good day, you hit 2. If you have a great day, you hit 3. If the market goes down the next day, you don't hit any, and I redo it every single day. So every position that I have, I change these every day. So going into Monday with Shopify, I gave you the 3 profit targets. I will enter those into my trading platform as limit orders for the day. And again, if I went into with 100 shares, right, I would place 3 limit orders. 10% of 100 is 10. 10 shares at the first, 10 shares at the second, 10 shares at the third. And again, if it goes down, I don't hit any, right? If it goes up. But over time, taking these little partial profits is hugely important. One, you reduce your position size, you lock in some profit, the market can't take that away from you. If after you enter, you hit a few profit targets and then it goes way against you, okay, at least you've mitigated your loss. And on top of that, as your position size gets smaller and smaller, it's just psychologically easier to follow your process. When you have a full position, that is the most difficult time for people to follow their process. But as you sell a little here, little there, little here, little there, and you start reducing that position size, it takes the account heat off of that. There's less stress because you have a less large position size. So it's super important. And I'll show you many examples today of why it was such a good idea to take these profits. But it just makes sense, right? If you're playing a game, you need to play offense and defense. We are playing a game when we are trading. In my opinion, you need to play offense and defense. You need to be attuned to both of these and pay attention to both. Okay, so I've kind of given you the setup of offense, defense, stops, this and that. Now let's just go through the trade and we'll play it out. We'll see how it happened. Okay, so here on the 18th again of November, I entered 140.47. Because of the rejection of the high of the order block. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and away we go. The next day takes off. Great. I hit a profit target. Perfect. Really nice. Next day, gaps up big. I hit multiple profit targets at the open, and I also got to trailing stop levels. Doesn't mean I do anything. It just means that now I'm in trailing stop mode. I'm waiting for the first close below the previous bar's low. The next day, down. No profit targets. Nothing. Next day, up nicely. I hit multiple profit targets. Next day, up a little. I'm not sure if I hit a profit target there. I'm not sure. I don't think so. Next day, up a little bit. Next day, down a little bit. And then here on the 1st of November, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares that I have, and I did that, and I took off half here, and I locked in a gain of 5.83% on half of the position. Now, after that, we keep going up, profit target, profit target, profit target, profit target, profit target, multiple profit targets on this particular day. So you can see every time the market's giving me something, I take a little of what it's giving me. So now at the moment, we are to 61.24 RSI. And so when I take a trade and it starts to go extended in my direction, if it gets to a 65 RSI level, then I have another rule that comes into play where if it gets to 65 RSI and then it closes below the 5 EMA, that's the end of the trade for me. Or alternatively, if we go up and reject the 70 RSI, I'm going to take off half the remaining shares. After that, if I have a close below a previous bar's low, I'm done and finished with the trade. So, kind of in a nutshell, when I take a trade and it gets extended and it gets to 65, 70 RSI range, most of the time that's when I'm going to exit and be done with the trade, right? But I have very specific rules, but on this particular trade, I don't have anything to show you yet, but I'm just saying as we get 65 RSI, 70, that's probably going to be close to the end of the trade. So the remaining shares that I have on Shopify doing very, very well, up 17.81%. And again, it started with the rejection of the high of the order block. Okay, let's go to the next trade. Okay, this is MO, this is Altria. Okay, this is exactly the kind of the opposite of what I was talking about with Costco. This is also an order block trade. We have an order block you can see from the past that has run into the future. The only difference with Shopify, I took a rejection of the high of the order block. This one, I took a rejection of the low of the order block. You can see on the day that I entered, it was below the order block and closed back in it. So that was my entry, 55.60. I position size, I placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below the low of this order block. Look how close we are to it anyway. The next day, had it closed 1 penny below, I just would have been out. That's the key with trading, having good risk to reward ratios when you start and structure the trade. This is a great risk to reward ratio. Okay. And then I also placed my 1.5 ATR trailing stop level above. Next day, went up, profit target. Great. Good start. Next day, up again, profit target. Good start. Then we kind of move sideways a little bit here. And then here on the 11th, we get to trailing stop mode. I'm not doing anything. I'm just waiting now in the future if I have a close below previous bar's low to get out of half. Next day, down. Next day is our first time that we close below a previous bar's low after reaching trailing stop level. What do? I got out of half of the shares that I have for a gain of 2.02%, but now I still have half. Okay, next day up a little, no profit targets. Next day down a little, next day up, profit target. Great. Then we kind of move sideways and then we start heading back down, but we're staying above our end of our stop. And then we move up here, we have a profit target. We move up here, we have a profit target, then kind of sideways and then kind of down. So it hasn't really moved. It's really moving sideways quite a lot here until this week where we moved up. Profit target, profit target, profit target, profit target. So I sold into that strength, and then we moved down, no profit targets, and then we kind of moved up a little bit, but not enough for profit targets. So, MO has not moved a lot, but it's doing fine. The remaining shares that I have at the moment are up 3.44%, which is really not too bad. Okay, let's go to the next trade. So that was also an order block trade. USO, all right. USO was a rejection of the high of the order block here on the 20th of October. Let's go back and look where this order block started. This order block started all the way back here on May of 2025. Swing low, swing high, lower swing low. Market structure change. When you have the market structure change, you can define the order block. Boy, did it take off from there and just went zooming up. Again, when you're way up here, can I look back here and go, this was smart money? Yeah, clearly it was. So I take that smart money area and I bring it into the future and I don't mess with it until it comes back to this area. Well, that's what happened. Look at this. It took many, many months, but it did come back to that area and it did reject the high of the order block. So I entered here at $67.81. What I position size. I place my emergency stop as always 2 ATRs below. If I get there, it's a 1% loss. My end of bar stop is a close below the low of the order block. That's 66.06, which is much closer to the entry than my emergency stop. I placed my 1.5 ATR trailing stop level above the price, and away we go. The next day, thankfully, moved right up after the signal. Great, profit target. Next day, moved up again. Multiple profit targets. I also got to trailing stop level. Next day, up huge again. I think I hit 3 profit targets on this day. So you can see this big surge that we had in the position, I'm taking advantage of that and selling into that. Now we got into trailing stop level here on the 22nd of October. So here on the 28th, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of my position. I locked in a gain of 4.97%, which is really, really good. And then, we're drifting down. Okay. On the days that it rallies, I'm selling a little into those rallies and then down and then selling a little into those rallies and then back down. But, in this case, am I glad when it was up, I took a little off here, took a little off here? Yeah, of course, because it went lower, right? And then we have a couple of, I guess, about 10 days worth of going up here where I had a few profit targets. And then we had a really big down move where this particular day on the 16th, look at this, this barely kept me in the trade. Had this closed below the low of the order block, I would have been out of the trade. But again, that order block did act as support and kept me in the trade. And then the next day, up big, multiple profit targets. Down, up a little, profit target, multiple profit targets here, another profit target here, and then down again on Friday. But it is that I am using the move up in the market to take advantage and taking off while getting is good, right? So the remaining shares that I have on USO are up 0.98%, but I am up a lot more on this trade. Why? Because of the partial profits that I'm taking, especially in those first few days, and then exiting half when we close below the previous bar's low after trailing stop loss. So, but the remaining shares I have up 0.98%. So grateful for that. Okay, let's go to the next position, which is AMD. All right, well, AMD is another order block. Why is it an order block? Well, look, here we have a swing low, here we have a swing high, here we have a lower swing low, and then here we break market structure to the upside. Once we break market structure to the upside, the lowest closing bar prior to market structure change, the high and the low of that is your new order block moved into the future. I'm waiting for the price to come back into the order block. Okay, in this particular scenario, you remember at the beginning of the podcast, I said that you can use a rejection of the high of the order block, you can use a rejection of the low of the order block, or you can use a rejection of some kind of moving average or other level inside of the order block. Well, in this particular case, you see the red line here. This is the 100-day moving average. The day before I entered, it closed below. The next day, it closed above. That is a rejection of the 100-day moving average. Now, a rejection of a moving average by itself can be a legitimate entry point. But what really, I keep talking about having confluences of signals. And the reason my favorite trade is a rejection of a level inside of a key level. Well, a rejection of the 100 is a level, but the rejection of the 100 came within an important other level, which is the order block. Anyway, I hope that makes sense. Levels within levels, and this is what happened. We had a rejection of a level inside an order block. So I entered here on the 18th at $201.10. I position size. I placed my emergency stop as always 2 ATRs below. My end of bar stop is simply a close below this 100-day moving average, or this red line. Okay. So as soon as I enter here 201.10, I place my trailing stop level 1.5 ATRs above as always. Next day, boom, takes off beautifully. Two things happen here. The first is I got to trailing stop level, so now I'm in trailing stop mode. The second is that I hit 2 profit targets on this big move up. So already I'm ahead of the game. I've taken off 20% of the trade, and I'm in trailing stop level. The next day it gaps up again, gaps up into a profit target for me. And then the last few days, we've just essentially gone sideways. But remember, we're in trailing stop mode because we reached it here on the 19th. So now, if Monday, for example, we have a close below a previous bar's low, I'm going to take off half. If it keeps heading up, I'm going to keep selling into that strength. Make sense? So I am in trailing stop mode, although I haven't had to do anything with it because we haven't had a close below. So the remaining shares that I have on AMD up 6.55%. But again, the key is here, I have a rejection of the 100 inside an order block. I have a rejection of a key level within a larger key level. That's the key, everybody. I'm telling you. Levels within levels. So this particular trade, remaining shares up 6.55%. Let's go to MasterCard. All right. Well, everything lately has been order blocks. I took a trade on MasterCard here on the 19th of November at $530.38. Why? It rejected the bottom of the order block. It went below the order block and then closed back in it. If we went to the left here, you would see that an order block was formed in the past, and I just brought that smart money into the future again. Was the smart money area correct again? Certainly was, right? Because I entered here 530.38 with the rejection of the bottom of the order block. So I entered, I position size, I placed my emergency stop 2 ATRs below. If it gets there, I would lose 1% of my account, right? Because we do the math. my end of bar stop is simply a close below the low of this order block. Look how close we are to it anyway. The very next day, it almost did close below. Had it closed below, I would have gotten out. But it didn't close below, it held, so I stayed in the trade. Once I entered, I placed my 1.5 ATR trailing stop level above. Okay. Next day, it started off great. There was a lot of strength. And I sold, I hit 2 profit targets into that strength before it reversed. Okay. But it did hold the low of the order block, so I held it. The next day was up big. Multiple profit targets. Next day, nothing. Next day, up, another profit target, and we got to trailing stop level. Doesn't mean I do anything. It just means that now I'm in trailing stop mode, which means in the future, if I have a close below previous bar's low, I'm going to get up half. That happened here on the 1st of December. We had our first close below a previous bar's low after reaching trailing stop level. I locked in half the position for a gain of 2.51%. Next day, up again, profit targets. Next day, up again, profit targets. Next day, gapped higher, up, profit target right at the high before it reversed. And then we went down, had a little bit of pullback. Then we had this huge bar up here. I think I hit 4 profit targets on this day. I always put 3 in, but you can hit more than 3, but I start with 3. But I think I hit 4 profit targets and took a lot of profit off into that move. The next day, up again, profit targets. Then we kind of moved sideways, and now we had a profit target here, we had a profit target here. In the last few days, we just really haven't done much. But look, we are at a 6601 RSI. Do you remember earlier I told you if I get to a 65 or higher, now the 5 EMA comes into play? Well, the 5 EMA is this thin blue line here. In the future, if we close below that anytime now, based upon where we are in this trade, anytime now, if we close below this 5 EMA, I'm done with the trade. That is it. If we go higher, I will continue to sell partial profits into that strength. But if we get and we reject the 70 RSI, I'm going to exit half the remaining shares that I have. And then after that rejection of the 70 RSI, if we have a close below previous bar's low after that, then I'm completely out of the trade. So the remaining shares that I have here are up. Been a great trade. 8.46%. Again, every trade I have shown you has started with an order block. That's why, without a doubt, they are my favorite entry signal. Let's go to Microsoft. Microsoft, again, another order block that I bought here on the 21st of November, 472.10. Rejection at the bottom of the order block. Position size. Place my emergency stop, 2 ATRs below. My end of bar stop is simply a close below the order block. We're so close to it anyway. I place my 1.5 trailing stop level above. Next day, up a little, nothing. Was below the low of the order block, but it the closing price is the important price for me. It closed back in, kept me in the trade. The next day, again, went way below the low of the order block. Had it closed there, I would have had to get out, but it gained strength, found buyers, closed back in the order block, kept me in the trade. The next day, up, profit targets. Next day, up again, a profit target. Now I'm in trailing stop mode. Next day, down a little. Next day, up, profit target on that up. And then here we had a big move down. It was our first close below a previous bar's low after reaching trailing stop level. What did I do? I had to get out of half my position, locked in a gain of 1.33%. Then we went up, profit target. Up a little, not enough for a profit target. Up big, multiple profit targets on this move up. And then down. But yes, it went down, but it never closed below the low of the order block, kept me in the trade. Little up here, but no profit target. The next day up big, multiple profit targets on that strength. And the last 5 days, we've essentially moved sideways. So no profit targets, but still in the trade. So the remaining shares that I have on this particular trade are up 3.17%. And again, this was a rejection of the bottom of the order block. UNH. All right, order block. This is a Well, I'll show you. So let's first identify the order block. Order block, we have a swing low, and then we have a swing high. And then we have a lower swing low, and we change market structure to the upside. So once we change market structure to the upside, I know where my order block is. It's this big bar right here. I move it into the future. Now, this gets a little more advanced. So again, you can take a rejection of the high of the order block. You can take the rejection of the low of the order block. You can have a moving average as your key level inside the order block, or if you know what you're doing, you can place your own kind of line in the sand in the order block. And that is what I did on this particular trade with this green line. You see, I have this green line. It's not a moving average. It's a line that I put in because I saw something. And what I saw is this bar here. Do you see this big up bar that we have? If you have a large up bar, generally the halfway point of the big up bar, there's going to be inherent Fibonacci, 50% Fibonacci support. Clearly, this was a big up bar, right? The low to the high, I marked the 50% area of this bar and I brought it into the future, okay? So remember, levels within levels. I entered UNH here on the 22nd of December at 324.90. Why? Because it rejected the halfway point that I put in manually of this halfway up bar. This is the green line. On the day that I bought it, it went below it and then it closed above that line. Okay, so this is my line in the sand now, is this green line. So I entered here 329 at 324.90. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply going to be a close below this line that I put in at 324 even. That is my entry point. If the next day it had closed below here, what would I have done? I simply would have gotten out. But you see how close my entry price is to this level anyway, right? Then, of course, I placed my 1.5 ATR trailing stop level above. The next day we went up, profit target. Next day, profit target. And then next day up here again on Friday, profit target. So you can see a key level was rejected inside another key level, which is the order block. So that's why I really love order blocks. I use the order blocks. They're easy to identify. And then I look for other levels, the rejection of the high of the order block, low of the order block, or rejections of moving averages and or levels that I put in myself. And so this trade has worked out really well. I'm not at trailing stop level yet, but the remaining shares that I have on this particular position are up 2.09% in 3 days. Not bad. FXY. All right, I've been in this one for a minute. FXY is the Japanese yen. And again, this is a very good example, everyone, of why it's so important, for me at least, to take profits while I have them. I entered FXY all the way back here on the 20th of November at $58.33. Why? Rejection of the bottom of the order block. Position size, I entered. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I'm very close to that anyway. I placed my 1.5 ATR trailing stop level above, and let's see what happened. As soon as it rejected the bottom of the order block, bam, way up, way up. Multiple profit targets right off the bat into that strength. And now I'm also in trailing stop mode. Next day down, no profit targets. Next day up, profit target. Next day here, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the position for a gain of 0.78%. Next day up a little. Next day up nicely, profit targets. Next day down. Next day up, profit targets. Then we have a slide of 4 days, no profit targets, no nothing. Next day up here, profit target. Great, selling into that strength. Gap open, profit target. Then down, profit target, down, sideways, big down. But did it close below the low of the order block? No, it did not. It kept me in the trade. Next day up, profit target. next day up, profit target, next day up, profit target, and then pretty big down day on Friday. So the remaining shares that I have on this particular trade are up 0.68%. But this is a very good example, everybody, especially on this particular market, of why it was important for me to take profits when I had them, because sometimes the market takes them away, right? So anyway, FXY doing fine, right? Selling into going in the future, selling into strength. It gives it to me. If it ultimately closes below the order block, I'm fine. I'm done. I'm out of the trade. If it continues up, great. I'll stay with it. Continue to take profit targets until we get to that 65 RSI level, and then if it does, the 5 EMA will come into play, and or a rejection of the 70 RSI to completely get out of the trade. All right, I think we have one more TLT. Okay, interesting. This is a little different. This is not an order block. I did enter TLT, which are US bonds. I entered those on Friday at $87.73. Why? Okay, this is what's called an abandoned baby. Abandoned babies are great setups. If you go to my YouTube channel, I have a video there that explains, the details of what abandoned babies are, but we'll do a little recap here of what abandoned baby is. Okay, an abandoned baby, everybody, this is the abandoned baby here. This bar here on the 23rd. Why is it an abandoned baby? It's an abandoned baby because the day prior, do you see how we closed here and then the day of the abandoned baby, we gapped down? So we had a gap down. Do you see the gap down? Okay, for abandoned baby, first thing is you need to gap down, and then the very next day you have to have a gap up. Well, we have that. We have a gap down followed by a gap up. Why is this important? The gaps from the close to the open are showing the sentiment of the market. Here, we gap down. The sentiment was very, very bearish. But the very next day, it gapped up. So we went from very bearish sentiment to very bullish sentiment in a very short amount of time. This is significant. This is telling you a lot of stuff is going on under the hood when you change sentiment very quickly. Really what it means is the market thought one thing, but then quickly it changed. So when you have an abandoned baby like this, about 70% of the time, depending where the abandoned baby happens, like, okay, we're down here near the negative third ATR channel, we're at low levels. In these kind of areas, generally, in my experience anyway, when you have a bullish abandoned baby, about 70% of the time in the future, you are going to be higher. So how do I structure the trade to take advantage of that? So when I have an abandoned babies, this is the one exception of how I manage the trade is different. I do not take partial profits. I do not have end of bar stops. It's very, very simple. When I have an abandoned baby, I entered, well, I guess I should further say that when you have an abandoned baby, gap down, gap up, my ideal is to wait for the mark after that baby's in place. I wait for a pullback and rejection of the high of the baby. So this is the top of the baby. That is the key support level. And so when the abandoned baby happens, I don't usually do anything with it until we come back and test and reject the high of that baby. Well, that is exactly what happened on Friday, right? The baby happened on Thursday, but I waited for the market to pull back, test the top of that baby, and it did. It tested it, closed above it. I got in at 87.37. So now that I'm in, like I said, I am going to manage this trade a little differently, and it's actually quite simple for me on these particular ones, because all I do is I position size like I regularly do, 1% of my capital divided by the value of 2 ATR, place my emergency stop 2 ATRs below. Boom, that's it. If it gets down here, I'm going to lose 1%. Now, on the upside, I use a 4 ATR profit target, 2 ATR stop loss to the downside, 4 ATR profit target to the upside. So I'm going into a trade that has a technical edge, not on every single scenario, not every single trade, but overall, using a big universe of numbers, I know more often than not this is going to be higher than lower. So if I'm right, I'm going to make 2% of my account. If I'm wrong, I'm going to lose 1% of my account, right? That is called an asymmetrical risk. I'm I have the ability to make twice as much as I'm risking. And that's hugely important, especially in a setup like this, where I know the preponderance of the odds are that it's going to be more likely that I'm going to have a 2 ATR profit target. I'm sorry, a 4 ATR profit target than a 2 ATR profit target. Okay. So I put a stop order in here at 86.46 if I'm wrong. And if I'm wrong, I lose 1%. I placed another limit order in here at $90.30 if I'm right. If I'm right, I'm going to make 2% of my account. If I'm wrong, I'm going to lose 1% of my account. And I set it and forget it. Eventually, we're either going to hit this or we're going to hit this for sure. But the key is if I'm wrong, I'm only going to lose 1%. If I'm right, I'm going to make 2%. And history shows with this setup, you're going to be right more than you're wrong. So if you're going to be right more than you're wrong, and when you're right, you're going to make more money than when you lose, that's a pretty good proposition, right? So I just started entering the trade. I'm completely break even on the trade. But again, in the future, I'm not going to take partial profits, go into trailing stop mode, anything. I'm either going to lose 1% by hitting my stop at 86.46, or I'm going to hit my profit target at $90.30. And in the meantime, this pays a monthly dividend as well. So anyway, I'm glad I was able to show you something other than an order block. So, all right, that is it, everybody. Those are the current open daily position. They're all doing really quite well, and I'm very grateful for that. Let me show you one more trade. This is UUP that I made on the weekly bars. Now, weekly bars close on Friday. Every bar that I'm showing you here is a week, so you make your decisions on Friday. And so this has been a really actually good trade on oh boy. Ah boy. You know what happened here? I'm going to have to show you this next week. It had a dividend and messed up all my charts and moved everything. I apologize, everybody. I'm going to have to rework this. I didn't notice this, but yeah, see the dividend that happened? And so it moved everything on my charts. I'm going to have to recalibrate this and show you. But, actually, I'll just show you right now without the order block. The order block is now up here, what used to be down here. This was my entry right here because the order block used to be down here. I'll have to show you next week. But anyway, we had to close under over the 200-week moving average, and we also rejected the order block. And you can see, so I entered basically here. And this has been a really, really, really nice trade. But the dividend moved everything down by the amount of the dividend, so it changed my entire order block. So I didn't catch that before. So I'll show you this next week. Apologize for this. Okay, let's move on and talk a little bit before we take a look at the potential trades for next week. Let's spend a few minutes. Let's talk about trader psychology. It is so important, and then we'll move on to the potential new trade. So let's take a look at trader psychology first. All right, everybody. This is a really good quote. This poster, Yummy, on X, really so good. You can follow her at Samurai Pips on X, and let's see what she has to say here. Really, when I read this, I was like, oh yeah, this person really is in the same mindset as I am as far as it comes to trading. When in doubt during a trade, ask yourself, what do my rules say? Not someone else's opinion, not your own emotions. The only voice you should heed is the voice of your rules. Doubt is born of opinions. Stability is born of rules. And really, this is true, everyone. You need to have rules. That's what I said at the beginning of the podcast. You need to have a process that incorporates good trading principles, technical analysis principles, good risk to reward ratios, confluences of signals, and then having rules and having a process that you can follow. There's many times when we're in a trade and we think to ourselves, oh, what do I do here? You really shouldn't think that. You should just say, what do my rules say? What about my rules? Okay, if it goes up a certain amount, I take profits. If it goes up above the 65 RSI, then the 5 EMA comes into play. If it rejects the 70 RSI, then I sell half. If I have a close below previous bar's low after rejecting the 75 RSI, I get out. If it hits my emergency stop, I get out. I know how much I'm going to lose, 1%. If it closes below my end of bar stop, I'm going to get out. Other than that, I don't have to think about it. It's a much more holistic way to trade, to be rules based and have if then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. You're going to make more money in the future if you have a rule based trading with a good risk to reward and multiple confluences. So I get it. We're all human. We go through these times where, oh, what should I do here? You really shouldn't have to think, what should I do? You should already have a predetermined plan that tells you exactly what to do. So let's read it one more time. When in doubt during a trade, ask yourself, what do my rules say? Not someone else's opinion, not your own emotions. The only voice you should heed is the voice of your rules. Doubt is born of opinions. Stability is born of rules. Get yourself from some rules. If you want, I can help you with that, right? Or any other trading program that you use. Great. But if you called me and said, Greg, what should I do here? I would say the exact same thing that Yumi says. I would say, what do your rules say? So get yourself rules and follow them. Your account will be very happy and much healthier if you start a trade with a good risk to reward ratio, multiple confluences, being very impatient with your losings, being very patient with your winners, and following those rules. So anyway, I hope this was helpful. And again, you can follow Yumi. I would highly recommend it at Samurai Pips on X. So thanks for that great post. All right, everybody, let us take a look at some potential trades for next week. I think I have some good ones here, nice confluences. Now they're not where they need to be yet, but they are getting close. They are within striking distance. So I always say this. So here I have 10 particular symbols for next week, 10 particular trades, 10 particular candidates. Now, is it possible that all these candidates could trigger on Monday? It is 100%. All 10 of them could trigger. Does that mean I would take all 10 trades? No, I would not. I'm only going to take one trade. Even if I have 10 that are great, I'm going to have to find the best one within those 10. I just have to do it, right? How do I do that? Well, I give it a score. If it has one entry signal, I give it a point. If it has two, I give it 2 points. If it has three, I give it 3 points, and so on, right? I also have to consider what the risk to reward is. I like to look at the larger time frames to see if I can glean some information from a larger time frame. So in other words, if I'm trading the daily, I may have to look to the weekly to see what the weekly is telling me. I also look at the relative strength of that particular market vis-a-vis the market. If the whole market's down but one's up, okay, the relative strength of that stock is stronger than the market. That would get another bonus point. So it's very important for me, and it's actually quite easy when you know what to do, of just if you have multiple candidates on a particular day, how to pick the one that's the best out of all the candidates. And this is how I trade. This is what I teach my students. And by the way, I do offer a 20-hour one-on-one course where I teach you all the different trading approaches that I use. We go through hundreds and hundreds of examples. We do all sorts of simulations. I have turned out some great traders all over the world. I have taught students from absolute beginning level all the way up to the hedge fund level and everywhere in between. And I would love to have you as a student. I will teach you everything that I know. We'll spend a lot of time together. We do 2 hours a week for 10 weeks. That's your 20 hours. And really, in my opinion, the very best way to learn anything is one-on-one with your coach. So you can ask as many questions as you want. I'm going to ask you a lot of questions. I'm going to throw you a lot of curveballs. But my goal is that when we're finished with this 20-hour course, that you are a really good trader and you know exactly what you're doing. So if you're interested, please send me an email. My email is in the link of the YouTube video, and we can get the conversation started. When I do get inquiries from potential students, I always write them back and say, Hey, great. Thanks for saying hello. Let's have let's do a Teams call. It's not a sales call, I promise you. I just want to learn more about you, your trading challenges, your goals. It's also a good time for you to ask me any questions about the format of the course. And that's it. Again, it's not a sales call. I just want to learn more about you and see if we're a good fit. And I promise you, if you take the course, when you're done, you're going to have a skill that you can use the rest of your life. So it does cost $2,000. It's definitely an investment, but I'm certain that you're going to be glad that you spent that money with what you're going to learn, what you would have learned. So if it's of interest, please send me an email and we can get the conversation started. Also, if you like online courses, I have a really good online video course at udemy.com. The link's in the description, where I teach you all the rules, all the steps to using the deep dip buy strategy, which is one of the courses that I teach in the one-on-one. It's a really good course. It's 9.5 hours of video. You're going to learn a lot there. I've sold so many around the world, and it's very affordable. It's between $30 and $50. So, okay. Let us take a look at the potentials for next week. Let's start with Boeing. Boeing, I am looking at a potential short. Now, so far today, we have talked about bullish order blocks where I have a green block. Well, there's also such thing as a bearish order block, and a bearish order block is the opposite of a bullish order block. A bearish order block is when you have a swing high, and then you have a swing low, and then you have a higher swing high, and then you break market structure to the downside. Now, your highest up bar close before market structure change is your bearish area. Well, the bearish order block is here on the 8th. You have the high and the low of the bearish order block. You bring that forward into the future. This is not smart money. This is dumb money. And you can see after we broke market structure here, we rallied right back into the order block, the bearish order block, and then look what happened. Just perfect. Well, now Boeing has rallied significantly, and we are coming back into this bearish order block. Now, I have talked to you about key levels within key levels. Well, first of all, anywhere in this red order block area, and that order block, the high is 226.19, the low is 221.47. This is a bearish area anyway. But you see the red line that I've placed in here, 222.50. Why did I place that? Because if you look over here to this little blue box, this is a bearish baby. We gap up, then we gap down. That is a bearish. There's significant bearishness to that when you're very bullish followed by quick bearish, and you can see, was it correct? It sure was. So level within level, the bottom of the bearish order block is at 222.50. That the bottom of that bearish order block resides in a bearish area as well, right? Key levels within key levels. And so we are not there yet. But what I'm looking for on Boeing BA is I'm looking for a rejection of 222.50 for a short. If it rejects, I'll get short. I'll place my emergency stop 2 ATRs above. I'll place my trailing stop level 1.5 ATRs below because I'm short. My emergency stop will be 2 ATRs above. My end of bar stop will simply be a close above 222.50. So keeping that end of bar stop close. So again, on Boeing, what I'm looking for next week is some kind of rejection of 222.50 to get short. My end of bar stop will be that 222.50 level. Intel. Okay, Intel has had a huge run up and a huge run down. Okay, we have a bullish order block here. Why bullish order block? We have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside. Here we go. In this big up bar here, remember I talked about when you have big up bars, 50% of that big up bar will be some kind of Fibonacci 50% support. This is at 33.80. This 33.80 level is within a bullish order block. So I'm looking at two things here on Intel. I am looking for a rejection of 33.80. If I get the rejection of the 33.80, my end of bar stop will be 33.80. Conversely, if we go lower, do you see the 100-day moving average poking its head inside the order block? I could also key off of the 100-day moving average. Currently, that is at 33.04. Remember, key levels within key levels. The order block by itself is a key level. Then I have two levels in there. I have the 33.80 level rejection, or I could also go with rejection of the 100-day moving average, which is 33.04. But it's not there yet. But you can see Thursday or Wednesday, I guess, look where it bounced. It bounced right at the top of the order block, right? I don't want to buy it this high. I'm looking for a rejection of 33.80 or a rejection of the 100 at 33.04. Coca-Cola. All right, we have a nice order block here. Swing low, swing high, lower swing low. Market structure change defines the order block here. The 3rd of November, the lowest closing down bar, moving it into the future. Well, what am I looking at? What I'm looking at really right now is basically one thing. I'm looking for a rejection of the 250-day moving average. The 250-day moving average is, where is it? 67.94 right here. Why? Because that's a key level within a key level. The 250 by itself is a key level, but it's inside the key level of the bullish order block. Then that gives me a good context, a good structure of a trade. If you know, it's far above. It doesn't mean it's going to do it, but if it does do it, then I will use that 250 as my level. Okay, makes sense. McDonald's MCD. Nice. We have two potential entries here. We have an order block, swing low, swing high, lower swing low, market structure change, defines the order block here. The high of the order block is 303.82, the low is 299.59, moving the order block into the future. I want to see a key level within the order block. I have two key levels. Oh, perfecto. Two key levels within the order block, the black line, which is the 200-day moving average, which is 303.14, or the 250, which is 356, right? So next week, if we come down, we reject that 200 within that bullish order block, great. I could take the trade there. My end of bar stop will be a close below the 200. If we go down and slice through the 200, but then react at the 250 and reject it, close above it, then I can potentially get in there, right? So I have two key levels. I have the 200, which is 303.14, or the 250, which is 356. But again, it may not get there. Probably won't get there. But if it does get there, those are the levels that I want to key off of. Doesn't mean I'm going to be right, but what it means is I'm following my rules. It rejected a level. I'm taking it. If I'm wrong, more than likely I can be wrong small. If I'm right, I have the potential for a large move up. And that's what you need. You're going to have a lot of losses in trading. But if you keep them small, it's fine. The rules are large gains are allowed, obviously. Little gains are allowed, obviously. Break-even trades are also allowed. Small losses are allowed in the calculus of trading, but you have to stay away from the large losses. You have to put yourself in a position where I'm in this trade, I could have a small loss, or I could have a big gain. That's what you need. All right. So a rejection of the 200 or a rejection of the 250-day moving on Coca-Cola in the order block. Netflix. Okay, Netflix really has gotten beat up, but it's coming to a key level. The key level is this order block all the way here back on the 4th of April. Okay. Inside, and so the high and the low of that order block is 90.66, 85.39. Bring it into the future. Again, when this order block was formed by taking out this swing high and the stock just went rocketing up, in hindsight, was this smart money? Yeah, obviously it was smart money. It went from $86 to $134. Okay, this was smart money before. We bring the smart money area into the future again. Is it smart money again? Maybe, maybe not. In my experience, more often than not. But this is kind of a tall order block. I don't want to just take a rejection of the high of the order block because the low of the order block is kind of a long ways down. So I'm looking for a key level inside the order block. There are no moving averages. There are nothing. But all the way back here on the 9th of April, we have a big, big up bar. Remember what I told you about big up bars? You have a big up bar. If it gets to 50% of that big up bar, that's going to be a key level. Well, that's exactly at $90. So I bring the $90 key level into the future, and now I have a key level within a key level. I have the $90 level, which is key, inside the bullish order block, which is also key. So what I'm looking for on Netflix next week is a rejection of $90. If it rejects $90, I'll consider taking the trade. If then in the future it closes below 90, that's my end of day stop. Pretty simple, right? But it may not get there. It may just take off from here and I miss it, and that's fine, but it's okay. The bus comes around every hour. You will have another trade that will come around and do what you want to do. But that's what I'm looking for on Netflix, is basically a rejection of $90. Then that $90 will be my end stop level. The Qs. Okay, couple different options on the Qs. We have a bullish order block in the green. We have a bearish order block in the red. If we head back down and we reject the 100-day moving average inside the bullish order block, then 100 is at $600.81. I would consider getting long there. However, we have a bearish order block up here. The bearish order block, and we have a bearish abandoned baby. Look, we gapped up, followed by a gap down. Remember, that is a bearish abandoned baby. And on a bearish abandoned baby, the low of the baby is the important key level of resistance at 630.30. Well, that 630.30 level is exactly the low of the bearish order block as well. So you can see we changed structure to the downside. Look where the market came right almost up to that level before it headed back down. Well, now we're creeping our way back up. So just to make it simple, on Qs to the short side, I am looking for rejection of 630.30. It either touches it, closes below it, goes above it, intraday closes below it. That would be my short signal. I would place my emergency stop 2 ATRs above, and my end of bar stop would simply just be a close back above the 630.30 level. So that's what I'm looking for. Two things. Short side rejection of 630.30, and then I'll use that 630.30 level as my end of bar stop. Or if we head back down from here, looking to the buy side of this 100-day moving average, $600.81 inside the bullish order block. RBLX. Okay, this is an interesting one. So let's talk a little bit about trend lines, megaphone trend lines. Megaphone trend line is when you have a swing low and then you have another swing low and you connect those swing lows. And after you connect it, that trend line continues to go out into the future. Well, we have two touches. We have the first touch, we have the second touch. If we have that third touch to the trend line down here, more times than not, that is where you will have a reaction. Bulls will come in and you will bounce from there. You can see we are not there yet. We had the first swing low and the second swing low. We've connected those swing lows, brought it into the future, and we currently have not touched that trend line. But if we do touch that trend line and reject that trend line, that would be a potential entry for me. Okay, and then I would use that trend line as my end of bar stop. In addition to this, what I like, in addition to this megaphone trend line very close to forming, we also have what is called a bullish MACD divergence. And this is, again, something that I teach in my one-on-one course, but these red bars here are MACD bars, bearish MACD bars. And you can see as we move down here, these got very deep. Well, we went deep, we had a bit of a rally, we went green. But the key thing is now, this price, we are lower here than we were over here. But do you see how the red bars, they're red, but they're not deep, not at all compared to how deep they were over here. So what is this saying? This is saying from a MACD perspective, you are running out of downward momentum by the fact that these bars are very shallow compared to these bars being very deep. Really what that's saying is you're running out of sellers. If you run out of sellers, the market rallies. You run out of buyers, the market goes down. So this MACD divergence is showing that we are running out of sellers, and it's coming at a key level where potentially you're rejecting that third point on that megaphone trend line. So that's the reason I'm highlighting RBLX here, because of the double bottom bullish MACD divergence and the proximity to the third touch of this megaphone trend line. If it rejects the trend line, I would consider taking the trade. My stop would just simply be a close back below that trend line. UNG, natural gas. Okay. A couple things going on here. First of all, we have a baby. Why do we have a baby? The baby's here on 22nd of December. We gap down, very bearish. Next day, we gap up, bullish. Remember, the quick change in sentiment from bearish to bullish generally indicates that you will be higher in the future. Okay. In addition to that, we have created a order block or a smart money area. Why? Because we have a swing low, we have a swing high, we have a lower swing low, and we took out the swing high, which forms the order block. So we have an order block that started with the bullish baby. And again, on babies, bullish babies, the high of the baby is the key support level. Well, that is $11.89. And in this particular case, that 11.89 is also the high of the bullish order block. So specifically what I'm looking for on UNG is if we have a pullback into the smart money area or back into the order block and a rejection of 11.89. If that's the case, that would be my potential long entry. My end of bar stop on this would simply be a close back below that 11.89 level. So very good risk to reward ratio. But technically, I like it. We have a bullish order block. We have a bullish abandoned baby. Coming back, pulling back a little bit would be normal, but the key support level would be 11.89. So that's the level I'm going to watch very closely on UNG. XLE, which is energy, the energy ETF, just a nice simple order block. Swing low, swing high, lower swing low, market structure change. The market structure change defines the order block here. The high of the order block is 43.72. The low is 43.19. That's the smart money area. We bring the smart money area into the future. Okay, I'm looking for a level within a level. I know where the order block is, but is there another key level? Yeah, there are two. We have the 250-day moving average, which is riding right at the top of the order block. That is at 43.73. The secondary level that we could look for a rejection would be the 200-day moving average, which is at 43.49. Both of these major moving averages, the 250 and the 250, reside in the bullish order block, levels within levels. So again, I'm looking for a rejection of the 250, 43.73. If it rejects that, my end of bar stop would be the 43.73. If we go through the 250, reject the 200-day moving average, that would be my secondary level, 43.49. If it rejects that, bounces, closes above, then that could be my entry. My stop would be a close below the 200. Okay. Last but not least, everyone, is XLU. Haven't talked about XLU. This is utility ETF. We have an order block way back here, September 8th. Why? Well, you got to kind of zoom out here, but look, we have a swing low here, we have a swing high here, we have a lower swing low here. We change market structure to the upside, which defines the order block, the high and the low of the order block. The high is 41.78, the low is 41.15. We bring the smart money area into the future. Is it there yet? No, it is not there yet. But within the next week, 2 weeks, we could certainly be there. And the key level that I am looking for is the 250-day moving average, which it resides inside the order block. Key level within a key level, the 250-day moving average is at 41.36. So right off the bat, that is what I'm going to be looking for, a rejection of 41.36 inside the bullish order block, key level within key level. All right. So there you go, everybody. Those are the potential entries that I'm looking for next week. I hope you found today's podcast helpful. If you have any comments or any questions, please write them in the comment section. I'll do my very best to get back, answer your questions, or reply to your comments. I always like to leave off, if you could try to go out and do one nice thing for another human being each day. I mean, if we all did that, the world would just be a better place, wouldn't it? So why not do it? It takes a few seconds or a few minutes of your day, improve somebody's life. I try to do that every day, and I just, everyone do it. This world could use some improvement, right? If you could also go out and do one nice thing for an animal each day, one act of kindness for an animal each day, they appreciate acts of kindness just like we do, right? We like it when someone helps us. They like it too. So why not do that? Why not try to make the world a better place? I just think it's a good thing to do. So I really appreciate you being here. I hope that you learned something of value. And God willing, I will see you next week. But have a good rest of your weekend. This is the last podcast of 2025. Crazy, huh? Year went by fast. But again, everybody, thanks so much. If I can help you with your trading, with teaching, anything, please let me know. And just have a good rest of your weekend. I will hopefully see you next week. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance, Result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.